This video will cover federal funds rate targeting by the Federal Reserve. We'll depict the Fed funds market before, during, and after the Great Recession, including during the COVID pandemic. We'll depict the Fed funds market using supply and demand curves. We'll introduce the concept of interest on excess reserves, and then we'll introduce overnight reverse repos and its interest rate. Overnight reverse repos are basically a collateralized borrowing by the Fed. The Fed is borrowing money using the collateral it has on its asset side of its balance sheet. It's borrowing money from non-bank financial institutions typically, such as money market mutual funds or government-sponsored enterprises that deal in the mortgage markets like Fannie Mae and Freddie Mac. Now let's graph the Fed funds market. Here we have the reserve market, or what I often call the Fed funds market. Now I'm going to unpack a lot of material here. And the first thing we want to do is we want to go chronologically, which is why I'm starting out prior to the Great Recession. The market worked in this way. The Fed funds market worked as I'm going to portray here for decades prior to the Great Recession. What I have here is a picture of what the market looked like in 2007. What I mean by that is we had a discount rate of 6.25%. We had a target Fed funds rate, like a pinpoint target of 5.25%. And then there was the cost of funds or deposit rate here, which is almost zero. And that's what you see here. What we see here is banks demanding reserves, and you got the supply of reserves that are issued by the Fed. But let me go just a little further. Sometimes it's important and helpful to put micro foundations and underpinnings to this aggregate model so that we can better understand it. Let's rewind, make sure we understand what the reserve market is. Remember, banks have to keep reserves to back up their deposits. And banks have to meet reserve requirements periodically. And for the most part, they do meet those reserve requirements. But on the margin, there's always going to be some banks with shortages because they have trouble predicting their cash flow, and they might be short some reserves. And there's going to be some banks that have excess reserves. And I'm making a distinction between aggregate, which is what we see here, and the individual bank motives for supply and demand that I just spoke about a second ago. So what we have here is the Fed funds rate. It's the interest rate or the cost of funds. It's the price of funds. Here's the quantity of funds or quantity of reserves. I'm going to use that word interchangeably, funds and reserves. And so we have an interest rate. We have quantity of reserves, funds. This is in dollars. We have a demand curve. It's downward sloping. The demand curve slopes down because it represents the opportunity cost of holding reserves. So when interest rates are high and we're up here, the opportunity cost is high, so the amount demanded here is going to be relatively small. As interest rates come down, the opportunity cost of holding funds drops until it eventually hits about zero here. And we got it modeled, so this is basically the cost of funds or deposits. Demand deposits is going to be close to zero. So how does the opportunity cost work here? Well, the banks can lend these reserves. This is cash that the bank has that it could lend in the loan market, or it can buy securities with a higher interest rate. Remember, this is a very short-term interest rate market that we're looking at. The Fed funds market is usually for overnight Fed funds. Sometimes they're longer. It's an overnight lending on an unsecured, uncollateralized basis. So the way this is working here is primarily dominated by banks prior to the Great Recession. So take a look here now at the demand curve. It flattens out because eventually you're going to hit near zero with this demand curve. And you're going to flatten out, and then there's, you're basically hitting the zero lower bound at this point right along here. Okay, so that's the demand curve. It's basically a standard demand curve, except for this flat spot. The standard demand curve that you're going to see in any economics course that's looking at interest rates associated with funds. So this is demand by banks. This is going to be supply by the Federal Reserve. On an aggregate basis, the Federal Reserve supplies a certain amount of reserves. And it increases those reserves if it wants to lower the interest rate, and we end up here, or it will contract reserves through open market operations, and it will bring interest rates higher. So it's the interaction of the banks and the Federal Reserve. The Federal Reserve is basically a monopoly supplier of reserves. And it's this interaction between the two that sets an equilibrium interest rate. And the Fed maneuvers this back and forth until interest rates hit 5.25% if that's its target rate that it decides on. So that's basically how the market worked. Now, let's look at this funny looking part of the supply curve. Now, what is this about? Well, if you notice carefully here, I call this NBR, non-borrowed reserves. Under normal conditions, there is nothing else other than non-borrowed reserves. And what I mean by non-borrowed reserves, those are reserves that haven't been lent out through the discount window. So the Fed can lend money through the discount window at the discount rate. And if it does that, and let's say it lends $100 million, let's say this is $100 million from here to here, or from here to here is $100 million. And these are borrowed reserves. You can't read that, but that's BR, borrowed reserves. And they're going to stay fixed at 6.25%. Remember how the discount window works. Sometimes banks have trouble borrowing in the Fed funds market because other banks kind of know how other banks are doing. And they're not going to lend to a bank that's in trouble because these are uncollateralized loans. So if that's the case, the Fed is the lender of last resort. So the Fed needs a mechanism to be able to lend to banks. And that's what this is. The discount window is a mechanism for the Fed to lend to banks that are in financial trouble. And so it's the sum of non-borrowed reserves plus borrowed reserves, BR here, to make up the total reserves. So now when the Great Recession hit, what happened was the Fed had trouble keeping this target Fed funds rate. It's like a pinpoint target. The Fed says, look, we want 5.25%. It tried to keep things exactly at 5.25%. But the problem is when the Great Recession hit and there's a lot of financial turmoil, it was sometimes above, sometimes below. And if it doesn't hit the target exactly, and the further it is away from this target, the less credible it looks. So eventually what the Fed did during the Great Recession is it implemented a target range. Instead of a specific number, they looked for a range. And so now let's move on to what happened during the Great Recession. And they're going to add a little more complexity to this graph and this analysis. So here's the Great Recession. Before the Great Recession, we're here with reserves. And then the Fed, when we hit the Great Recession, started to buy trillions of dollars of treasuries and mortgage-backed securities. And when it did that, and it increased the asset side, it paid for them with reserves, and so reserves shot out, way out here. The reserves shot out. Now, let's look at this range here. It's almost a little thicker than my pencil. And the Fed started out and created a Fed funds target range. In this case, the range goes from 0.25% to 0.05%. So this is in the middle of the Great Recession. This is what happened. And the Fed set a target range of about 0.2%. And it set this range, it set the upper end of the range to be the interest on excess reserves, and it set the lower or the bottom end of the range to be 0.05%. And it's based on the overnight reverse repo rate. That's what that stands for. Now, what does this mean? First, let's look at interest on excess reserves, this 0.25% rate. So during the Great Recession, the Fed decided to start paying banks interest on excess reserves. They also pay and have an interest rate associated with required reserves, but let's focus on excess reserves. That was 0.25%. So any reserves that banks had above their reserve requirement would earn 0.25%. The Fed wanted the banks to hold reserves and actually paid them to do that. And so as you can imagine, look, if interest rates are coming down and this supply curve is moving out, right? What happens is you end up on this flat part of the demand curve. When reserves have shifted far to the right and we're in the flat spot of that demand curve, it's sometimes referred to as an ample reserve regime. Now let me explain the Fed funds target range, its ceiling, and the floor to the range. So here's the way to think about it. This demand curve actually comes down here. It comes just extends down till it hits zero, like I showed you in the previous graph. But this demand curve is not really relevant for banks. Here's the way to look at it. This kink here starts where the interest on excess reserve number is. And so it's going to hit at 0.25%. The reason this kinks at 0.25% is because there's no bank that's going to want to lend money in the reserve market, in the Fed funds market, at a rate below 0.25 for two reasons. One, it can just leave the money at the Fed or on its balance sheet and earn 0.25. Why would it ever want to earn anything less? Not only that, but if it lends at a rate less than that and it actually lends money, it's at risk because it's an uncollateralized, unsecured loan. So it's crazy for a bank to want to lend it down in this area. So this interest on excess reserves sets a floor for the interest rate for banks. And that's the important part. This is the floor associated with banks because banks hold reserves. Now, there are other players in the Fed funds market besides banks. And those primarily are the money market mutual funds and the GSEs, the government-sponsored enterprises that are involved in the mortgage market, Fannie Mae and Freddie Mac being two big players. They don't have reserve requirements, so they don't have this opportunity cost of funds. So this is the opportunity cost of funds to a bank, but it's not an opportunity cost of funds to an agency like Fannie Mae and Freddie Mac. So while interest on excess reserves doesn't pertain to government-sponsored enterprises and money market mutual funds, those funds and government-sponsored entities can participate in overnight reverse repos with the Fed and therefore earn that 0.05% on reverse repos. I will explain what an overnight reverse repo is in a moment. Now, continuing with the story about the target range, well, how far can this rate go? How far can this rate go down? And there's the question. Well, it can go further, especially if we're up here and say this whole thing is shifted up, which I'll show you in a minute. It's like, well, how big of a range can it be? Well, the Fed puts a floor on the range, and the floor is put on by this overnight reverse repos. Overnight reverse repos are loans to the Fed. So the Fed is paying this 0.05%. And the thing to keep in mind is that these overnight reverse repo rates, that 0.05, is the lowest interest rate that any financial institution will accept. They won't go anywhere lower than that. That includes banks, money market mutual funds, and the GSEs, the government-sponsored entities. None of them will accept the rate of return lower than 0.05%. And so since the Fed is determining these two rates, it just comes out and says this is the rates we want, and then this is the target range, and that's the way the market works, independent of the supply. So the supply could be anywhere. The Fed's just going to say, look, we want interest on excess reserves to be here. We want the interest on reverse repos to be here, and we're going to manage the Fed funds rate to be anywhere in this tunnel, or channel is sometimes called. And this is the channel and tunnel and range from 2009 to 2016. Now, what's really interesting about this, and this can only happen through a monopoly like the Fed. So in other markets, you can't manipulate the market like we're seeing here. But this is basically the Fed's balance sheet tool. These reserves, huge, are the result of the Fed using its balance sheet. So the balance sheet by itself, people will refer to that as a tool. What do we mean by that? Well, that's where the quantitative easing comes in. It bought trillions of dollars of assets. That's on the left-hand side of the balance sheet. You have to get the balance sheet to balance. So the right-hand side is it increased reserves to pay for those assets. And so the banking system and the whole financial system is flooded with reserves pushed out here. Okay, so that's the balance sheet tool. And when you have this balance sheet tool and you have interest on excess reserves in this overnight repo, this range, you've disconnected supply and demand, right? We've disconnected supply and demand from the interest rate. So it's no longer the intersection of supply and demand that's determining interest rates. It's the Fed saying, look, we're going to have an interest rate here for excess reserves. We're going to have an interest rate here on reverse repos. And it's going to be independent of the balance sheet tool that we have and the amount of reserves. So let me show you what happened in 2019. Here's what happened. Before 2019, the Fed, in a series of moves, increased the interest on excess reserves from its Federal Open Market Committee. It just comes out and says, look, we want the interest rate to be this. Over time, it notched up all the way to 2.4% by 2019. And then the interest rate on reverse repos was set at 2.25. So this is the narrow range for the Fed funds rate. Now look carefully at that upper range. Is it in any way associated with where supply and demand meet? And the answer is no. There's a supply curve way out on the right, and you just have by decree the range of 2.4 to 2.25. The demand curve really doesn't have any play in this scenario. But there's more to the story. Another reason that the Fed started paying interest on excess reserves is this. Suppose the Fed runs out of assets on its balance sheet. It's a big suppose or a big if. But what happens if it starts running out of assets and it has nothing to sell in open market operations to try to pull these reserves in and raise interest rates? What's going to happen? It's going to run into a problem if it wants to raise interest rates and pull supply back. So what it did was it instituted interest on excess reserves, and now it decoupled supply and demand. So the interest rate's set here, and we got supply here. They're disentangled. And by the way, the amount of quantitative easing that goes on is measured approximately by this. So you got the supply of reserves, and so some people will refer to this as quantitative easing, the big asset purchases they did during the Great Recession. Some people believe that the reason that quantitative easing starts at the kink is because during the Great Recession, very early on in the Great Recession, the Fed lowered interest rates almost down to zero, and then it conducted its quantitative easing. Nobody knows exactly where this kink is, and nobody knows exactly what this amount is from a graphical depiction. We estimate what the quantitative easing is because we can tell what the Fed purchased and sold during that time period. So now let me go back to prior to the Great Recession to show you a concept. So here's the market before we had interest on excess reserves. Basically, it was the market in conjunction with the Fed determined what the target Fed funds rate, the intersection of supply and demand. And so remember, whenever you're looking at supply and demand graphs, you move along these curves when you change a number on this axis. So when you're changing this variable, you move along these curves. If something else happens to the economy that affects demand, then it's going to shift demand curve out, or it's going to shift it to the left. Now I'm going to ask you a question. What do you think would happen under the old system here if the Fed increased the reserve requirements? Well, if it increased reserve requirements, it's not a change in the Fed funds rate, and it's going to increase demand. Banks are going to demand more Fed funds. They're going to demand more reserves. It's going to shift this demand curve out. And what that means is there's going to be more demanded at each and every interest rate. So you think of this shift as a rightward shift. Sometimes you can think of it as an upward shift, but it's an outward shift. If the Fed cuts the reserve requirements, drops it from ballpark 10% that it is now to 9%, that would be a shift in the demand curve. So now let's fast forward a couple of years. So now it's 2021. Where are we on this graph in terms of interest rates and aggregate reserves? Well, this was 2019. In fact, I covered this up. It's early 2021. We're still in the pandemic. Well, reserves were here in 2019, but the Fed just increased reserves by a couple of $1 trillion, moved it all the way over to here. And what they also did was they took this range and brought it right back down to where we were. So where are we? We're basically out here somewhere. And again, it's what we call an ample reserve regime is where we are. Ample reserves. And interest rates are basically at the zero lower bound. And so we're way out here with low interest rates. So there's one more really interesting thing that happened since the coronavirus hit. And that is the Federal Reserve, in stating that we are in an ample reserve regime, said that they have suspended, well, I'm using the word suspended, they didn't use that word, but I think that's what they're doing, suspended reserve requirements until we get back into a normal situation. In other words, these ample reserves, which are way out here, come back into play. Somewhere along the line, they'll reinstitute reserve requirements. The money multiplier, as I said before in another video, the money multiplier still works. It's just that you set the required reserves equal to zero. You know, you got to speculate why that is. It's hard to find literature from the Fed stating exactly why they did that. But it seems as though what they're saying is there's so much reserves in the banking system that reserve requirements don't really matter at this point. Basically, everything is an excess reserve. So this interest on excess reserves applies to all the reserves that they hold. And the demand curve for the Fed funds market is really the demand curve for the money market mutual funds and the government-sponsored entities that deal in the reserve market, in the funds market. So I say temporary or suspended the reserve requirements. You got to remember, if you go back into history, you go back into the 1800s, and I'm sure if you go back even further, you'll find that banks had reserve requirements. So we've had reserve requirements under normal conditions for centuries. It's going to come back. It's just a matter of when. And the question in my mind, like I've said before, is like, when are these reserves going to start being reeled in so that we get back to normal? Who knows when that'll take place? I hope you can appreciate the chronological presentation done here. You simply can't appreciate this model until you look at history and how things unfolded. Because if you looked at it now, it would be very hard to make sense. But once you see the history behind it, then you say, oh yeah, okay. It used to be a true market of supply and demand, private demand, supply issued by the Fed, and then how things changed over time with the Great Recession and now in the coronavirus. So I think it will be very interesting to end this video by looking at an actual graph of the Fed funds market, the interest rate on excess reserves, and I also have here in green the 90-day non-financial commercial paper interest rate. So remember what I said earlier. I said that, look, the Fed moves the Fed funds rate in an attempt to manipulate the economy, moving interest rates up to slow the economy down, moving interest rates down to spur the economy. And when they do that, they're moving primarily the Fed funds market. But when the Fed funds market changes, that interest rate changes, it changes all short-term interest rates for the most part. And that's why I have the commercial paper market interest rate. And so you can see, big picture, the green and the red and the blue all line up, although the blue starts right here because interest on reserves didn't start until the middle of the Great Recession here in the shaded area. So let's look at this. So here we have right here the dot-com bubble, the internet bubble, where the stock market was roaring. And so the Fed raised interest rates to try to offset the possibility of inflation. That never really materialized because we had such big increases in labor productivity. But we did have a stock market bubble that popped. And when the market bubble popped, it caused the economy to go into a mild recession. 9/11 hit nearly simultaneously, and that helped solidify the fact that we got into a recession, this shaded bar. And interest rates came down, they came down. Then, because rates were really low, the Fed had to raise interest rates to try to cool off the economy, specifically around the real estate market that was bubbling over. So they raised them all the way up over 5%. Then a recession starts, the subprime crisis hits, and the Fed starts lowering rates to try to spur the economy because they see that we're in a recession, unemployment's increasing, and GDP is falling. And then you can see this spike. So nearly all the rates here are fairly consistent and highly correlated, except right here. And right here is Lehman Brothers collapsing in September of 2008. That was probably the most shocking thing to happen on Wall Street since the Great Depression and the banking collapse in 1929, 30, 31, 32, and 33. And so rates came down. We hit the zero lower bound, basically coming to near zero with interest rates. And then the Fed started notching up interest rates. They were trying to bring reserves back and increase rates to a normal situation and also to head off inflation. Even though there really was no inflation, they were kind of imagining that there might be inflation. In other words, inflation expectations, pi with an E superscript. That's what at least was in the Fed's mind. Some politicians were screaming at them that, look, there is no inflation, so why are you raising rates and trying to cool an economy that's going great? Then look what happened. So in green here, we have the coronavirus. And you see right here, the turmoil, at least in the commercial paper market for a short period of time. So what happens is when these green rates, this green rate, which is commercial paper, gyrates up and down, it's often hard for the Fed to manage interest rates. Things are gyrating back. It's hard for the Fed to pin down the red and the blue line, although it looks like they did a pretty good job here. It's just that the private market with the commercial paper market really reacted heavily to what was going on. And then look, we're back to the zero lower bound. In fact, and I didn't think this was possible, but if you look really closely, we're at a zero lower bound that's even closer to zero than it was before, right? Which is amazing. It's at 0.05 at this point, right? It's the interest on those overnight reverse repos. So it looks like the graph is picking up the lower bound of the target range. So we really hit rock bottom in terms of nominal interest rates on the Fed funds.